Hey guys, want to hear something really funny and hilarious? It's Rafi from the Endgame Investor, and I found something really funny that made me crack up pretty hard for a while. And I'm the only one who would laugh at these like obscure, arcane monetary developments like this because I'm the only one who gets them. I'm not the only one. Like there are other people. There's like a handful of them, maybe like 15, 20 people on the planet, maybe more. I don't know. It's a relative minority, less than 1%, let's just say. I'm in the 1%. I guess does it make me rich that I understand my anyway? The point is that remember that reverse repo facility that the Fed introduced that is siphoning off like $2 trillion a night from the banking system and keeping excess reserves out of the banking system. Well, it's causing some problems now. It's causing a massive drain of deposits away from the banking system because when you put deposits in a bank, let's say it's Silicon Valley Bank that might go bankrupt any second, and it did go bankrupt any second, it actually is bankrupt now. And I have all the other regional banks, all these deposits, and you have these depositors that are worried that it's going to lose its banking status or whatever it's called when a bank goes bankrupt and they're going to lose their deposits. So instead, they pull their money out into what's called money market funds, which can access reverse repo facilities from the Fed. And reverse repo facilities are when you give cash to the Fed and they give you interest. And what is that interest rate? It's about at the overnight rate, which is attracting funds out of the banking system into the reverse repo facility, which is managed by the Fed. Now, if you can earn, what is it, like 4.5% or something on reverse repos outside of the banking system, why would you keep them in a bank? And who can access reverse repos outside the banking system? Money market funds. And so you have all these dollars that are being sucked out of the banking system into money market funds, which can access the Fed's reverse repo facility, which is now about $2 trillion or more. Let's go to the graph. If you hit the reverse repo facility, if you go on a maximum timeline here, you can see our really kind of like edged up a little bit in 2021 after the mega printing of the lockdown money printing bonanza in 2020, 2021. And you had this go from basically zero in 2020, November 2020, even to right now about 2 point whatever trillion dollars, 2.4, 2.173 trillion dollars. That's all the extra money that is earning that interest. That can earn interest on money market funds, which is where all the bank deposit money is going. So you look at this Axios article here, the controversy it says to banks, this reverse repo facility is unwelcome competition because the banks cannot pay this level of interest on their deposits because they are not doing very well financially. They benefited, says this article, from their unique access to liquidity and safety from the Fed. Lightly regulated money market funds are a threat to that, and all the more so in this jittery moment. The Bank Policy Institute, there's an institute for bank policy, believe it or not, the research arm of the bank lobbyist industrialist complex. There's so many complexes, it's so complex. This week called the repo facility a black hole for bank deposits, right? Because if you're going to earn zero on bank deposits, you're going to earn 4.5% reverse repo. What are you going to pick? You're going to pick the yield, the BPIs, that's the Bank Policy Institute. They're the institute that is in charge of bank policy, whatever that means. Greg Baer and Bill Nelson argue that the facility is essentially sucking money out of the banking system that would be put into more productive use
Suck, suck.
for the economy if it stayed in banks. The facility is subsidizing money market funds as an attractive alternative for uninsured bank depositors. They write that makes perfect sense. The bottom line to a first approximation, this is a quote, to a first approximation, if the reverse repo facility were to go to zero, as it did in 2017, that would be roughly $2 trillion more that would flow into the banking system. Former Fed Vice Chair Richard Clarida said Wednesday in the panel at the National Association for Business Economics.
Helmet, what's going on?
Sanders, what's going on?
It's Mega Maid. She's gone from suck to blow.
I do think at some point the Fed does have to think about what is the role of the reverse repo. It's to suck excess reserves out of the system so you don't have a flood of $2 trillion flooding the banking system and causing hyperinflation. That's what the point is, Clarida. In case you're not clear about that, he added that it worked well for its purpose of keeping a floor on our interest rates during this time at the central bank, but it's not doing that now. It's a question mark. And I'll leave it at that. Well, he leaves it at a question mark. Isn't that great? He's leaving it as a question mark. What do you think happens to the banking system? $2.2 trillion floods into it. overnight because they decided to end the reverse repo facility. So on one hand, you have the reverse repo that's sucking money out of the banking system. On the other hand, if that reverse repo facility is ended, then all that money goes flooding back into the banking system, and you have hyperinflation because $2.2 trillion will affect prices just a little bit, I would think. And so another indication that the Fed is ending its mandate, it's ending its existence. It is running out of time. It is going to have to trigger hyperinflation at some point soon. And one more potential source of that is the reverse repo facility that has ballooned to $2.2 trillion since November 2020. Reverse repurchase, reverse repo operations are like a mop that soaks up all of the excess liquidity from the banking system, except it's sucking it from banks that need these deposits to survive. And they're all going to the reverse repo facility. Now, I want to show you something.
I want to show you something. I want to show you something. This is my new mop.
It's the new mop. This is a chart that I just showed you. Overnight reverse repurchase agreements, Treasury securities sold by the Federal Reserve in the temporary open market operations. This is the amount of reverse repurchase agreements on a quarterly basis. And you'll see in a second why I did it on a quarterly basis instead of a daily basis. See, it is now, as of Q4 2022, the last quarter, 2.553 trillion as of the end of the period, Q4 2022. Now let's go to this chart. This is money market funds, security repurchase agreements, Federal Reserve reverse repurchase agreement operations, asset level. How much of these reverse repurchase agreements are for money market funds? Well, we have here the number, 2.339620 trillion, 2.34 trillion. And how much was it here in Q4 2022? 2.553 trillion versus 2.34 trillion. Virtually all, like 90%, whatever that number is, 2.3 to 2.5, it's virtually all of it, minus a few $100 billion. But who cares about $100 billion anyway? It's like nothing in this monetary environment.
$100 billion.
So virtually all of the reverse repos that exist today are benefiting money market funds, and people are sucking deposits out of the banking system and sticking them into money market funds, which are benefiting from these reverse repo agreements. So what do you think happens when the Fed takes away the reverse repurchase agreements? Then all the money gets dumped out of money market funds back into deposits, right back into the banking system, except where they were before, these minor banks, these regional banks, will likely all be bankrupt at that point. So either the money gets put in money market funds and destroys regional banks, which cannot access the reverse repo agreement system, or all of this excess money is stuck in the banking system, causing hyperinflation. It's one or the other. There is no way out. And let's look at the primary risks for money market funds. We'll take a look at the Goldman Sachs money market fund just as an example. Principal investment risks of the Goldman Sachs money market fund. Interest rate changes, interest rate increases can cause the price of a money market security to decrease. Income risk, a low or negative interest rate environment can adversely affect the fund's yield. You could lose money by investing in the fund. Although the fund seeks to preserve the value of your investment at $1 per share, it cannot guarantee it will do so. An investment in the fund is not insured or guaranteed by the Federal Deposit Insurance Corporation. That's very Orwellian word, corporation. Sure, it's not a corporation, or any other government agency. Fidelity Investments and its affiliates, this is actually the Fidelity Money Market Fund, I apologize, it's not Goldman. What's the difference? The fund's sponsor have no legal obligation to provide financial support to the fund. And so, if reverse repurchase agreements suddenly end, or the Fed pushes rates back down to zero to save the banking system, what happens is that these money market funds get stuck with trillions of dollars that are suddenly earning nothing. And it could end up breaking the buck or destroying these money market investments overnight. And so all that money gets lost. This is sort of what happened in 2008 when money market funds invested in something called commercial paper, which is basically a fund that allows companies to outsource their payroll to other interest rate in earning systems or something like that. And then commercial paper started falling because of the 2008 financial crisis, and the money market funds ended up breaking the buck and people lost their money in money market funds. And basically, here's the problem. when the Fed has to push interest rates back down to zero because of a financial crisis, then all the money market funds risk breaking the buck and all that money starts getting lost. Because when the Fed pushes rates back down to zero, reverse repurchase rates also go back down to zero, which means there is a high likelihood that when the Fed is forced to push rates back down to zero, that itself will cause a financial crisis as well. And so there is no way out of the next financial crisis, especially not by pushing rates back down to zero, because that itself will cause a financial crisis due to the trillions of dollars locked up in reverse repurchase agreements that are feeding money market funds. Did anybody in the Fed think of this? No. They don't think of things. They just print money. That's all they do. That's all he does.
That's what he does! That's all he does! You can't stop him! He'll wait for you, reach down your throat, and pull her heart out!
This is Rafi of the Endgame Investor. If you haven't figured it out right now, it's probably a good time to buy gold and silver. And you can do that by calling 855-GAME-END, where you'll reach MilesFranklin, and you can call them by their regular phone number and just mention that the Endgame Investor, Rafi Farber, referred you to them. From what I know, they do have the lowest prices on the whole of the internets. And anything that you order will be shipped discreetly so that nobody knows what it is as it is in transit to you. Long live money market funds. And I wish everyone a good end game whenever it gets triggered.
I told them in another couple of hours this whole thing would be over. So stay. Be nice.
This is Rafi of the Endgame Investor. If you enjoyed this video, then sign up for a 2-week free trial of the Endgame Investor or become a Patreon on Patreon, where you know what I do. I give a biblical commentary on monetary and economic policy topics. Is there a biblical interpretation of the reverse repo facility? I don't know yet. I haven't looked it up, but I could probably find something because I'm pretty good at that stuff. Anyway, I'll see you guys whenever I make a video next time, which could be at any point now. I don't know. We'll see.